So we kind of have a two-part program on this today. And for the first one, climate reporting mandates, state, federal, and global. Let me first introduce our speakers. We're going to have Amy Beers. Amy is, give me one second. She's CPA, CGMA, Senior Director of Assurance and Advisory Innovation at the AICPA. Before joining the AICPA, Amy served in a number of financial management roles, including controller, treasurer, and VP of finance at both public and private companies. She began her accounting career as an auditor at Ernst & Young. And Amy has been has had a big focus on XBRL at the AICPA and has been really instrumental in helping us move XBRL forward in the accounting arena. Our second speaker is John Turner, and John is going to be on Teams. He's joining us remotely from Oxford. John is the CEO of XBRL International, which he has led for 10 years. And previously, he was the CEO of Core Filing, which is a software company also in the XBRL space. And I believe Core Filing is one of our sponsors today. So first, we're going to have a presentation by John. But just to give you a little bit of background on this, and the reason that we have this session is because we're here to talk about meeting the needs of investors and regulators and companies themselves, as Elizabeth was saying. And many of the climate mandates that we're seeing around the world and even here in the United States include digital XBRL preparation. So we're seeing a lot of these mandates, and it's interesting to kind of look at the intersection, and that's what we're here to talk about during this program today. So we're going to have a presentation by Amy, and then we're going to move on to, by John first. And then we're going to move on to Amy, and then we'll have a few questions. So with that, I'm going to turn it over to you, John.
Thank you very much, Michelle. With a bit of luck, a video might pop up. Let's see if that works. Oh yeah, there you go. Good afternoon, everybody. Hi. Evening here in the UK. So thanks very much for the opportunity to speak. I'm going to go through some slides, a few of which are introductory, and I know we have a mixed audience today with a variety of knowledge on these topics. So for those that are well imbued in all of this, apologies, you've heard some of this before, all of it before, but let's see. So just very briefly, what is XBRL International? You're here at the XBRL US event today, but XBRL International is the global standards development organization. We are a not-for-profit, another Delaware not-for-profit. Our standards are freely licensed and are used all around the world. We have an explicit public interest purpose, which talks about transparency and improving accountability, but you can think about it as trying to help move the world from paper reporting to data reporting. And we are getting long in the tooth. We're more than 20 years old now. Next slide, please, Michelle. So for those of you unfamiliar with XBRL at all, here's a very simple analogy. Everybody needs to use the same alphabet and grammar. And that's actually a set of specifications, which we really don't want you to look at unless you're a software developer. But those specifications, which everybody uses, means that software can exchange information in an interoperable manner. But an alphabet and grammar is completely useless if we don't have dictionaries. And that's where Elizabeth and her colleagues at the ISSB and their counterparts in many contexts right around the world, because XBRL gets used for all kinds of things: tax reporting, financial reporting, prudential reporting, real estate reporting, energy reporting, lots and lots of different domains, but increasingly climate and sustainability disclosures. However, the regulators or standard setters need to define the words in that dictionary, and that provides a dictionary for reporters to utilize. So we call those things taxonomies. In the sustainability space, that sometimes confuses folk because there's these ideas of taxonomies that really are about splitting up industries. But bear with me, these dictionaries or taxonomies are used to facilitate digital reporting. Next slide, please. We do very much live in a digital age. The idea that we are all going to go around and read a large number of paper reports that we've printed out, or even PDFs on a page, is pretty laughable in today's society. There's been a lot of implementation. There's more than 216 implementations, not counting any of the upcoming sustainability ones, in more than 70 countries. We're also seeing a lot of interest in developing and emerging markets, particularly because of the work of the ISSB, in fact. But we'll see how that plays out. That report that Elizabeth just mentioned is well worth a read. Next slide, please. So many of you in the room are very familiar with XBRL reports, but if you've never seen one, well, here's a flash floppy one. This is the kind of thing that is being used in Europe. This is a report for an insurance company. It's an insurance company called Aviva. Grab the slides, you can click through and play around with that report. But on the right-hand side is a viewer. And for those of you more familiar with the SEC, well, if you go and look at your company or any other company on the SEC's EDGAR system and look at one of, for example, a Q or K, quarterly or annual report, you will see little orange underlines. Click on the orange underlines and you'll see something similar. In this case, this is looking at a GHG emissions disclosure that is being made by that insurance company. But that process is, in effect, what is being introduced for the first time on a mandatory basis and in a digital basis in many parts of the world. And we'll come back to the US. In fact, Amy's going to cover that in that area kindly. Next slide, please. So those taxonomies or dictionaries, you can access them on the web. You can access them in a variety of software, but they are a detailed, granular, and connected set of definitions which cover the manner in which the information that's being defined by the standard setter is captured in a digital manner and in a way that can be used in reports. Next slide, please. Why would you want to do that? Well, because you might want to look at all of the data. So this is, again, using a European example. It's this particular case, we're focusing on just Belgian companies which don't seem to be able to cover their interest payments with the cash that they're generating from their operations. So they're in sort of, by definition, a zombie company. That process of providing those analytics is drawn directly from the XBRL materials. And again, you can download these slides, click through to that link at the bottom right, and play around with that information. We have lots of other examples of that nature. You can find details on the xbrl.org website. But in effect, this is the kind of things that your regulators are doing and users of all kinds are doing with your data. So it's very important that issuers understand that that's the reason this information is collected and what is happening with that information. Of course, in many contexts, your investors won't see this information directly. They're being used by information providers. Next slide, please, Michelle. Speaking of investors, as I think Elizabeth really hit it up correctly, much more succinctly than I have on this slide, she was describing those situations in which you've got a error in, say, an emissions disclosure that might be out by 1,000%. That's not uncommon. And as a result, you see all kinds of problems in the data which investors have been frustrated with, and that process is being resolved through this sort of global standardization being led by the ISSB, but it's not quite as simple as that, as we'll see. Next slide, please. If you take nothing else away from today, have a look at this paper if you've never read it. This is a 2016 paper about non-financial measures. And of course, once upon a time, the valuation of companies was very tightly connected to book value. These days, it's a long way away from that, and less than 50%. And in some cases, it's even just a fraction of that. Why? Because of intangibles and other aspects like business models that impact the valuation much, much more than what's on the balance sheet. So questions about business models are much more important to investors than they were, as well as things like vulnerabilities to external shocks. I'm a keen coffee drinker. If you want to learn about vulnerabilities to external shocks, go and look at the spot prices for coffee. They're only going one way, and that's very much down to a number of hurricanes and things this year that have impacted crops this year. But those kinds of exogenous factors are things that investors are increasingly interested in, and that's why the ISSB is doing its work, and some of their peers are doing similar work in other parts of the world. Next slide, please. So, as Elizabeth has already covered, we've had voluntary frameworks that have developed over 20 or so years. It's sort of been unfairly described as an alphabet soup. Hey, it was a great place for people to learn. Lots of different work going on there, but it was a terrific amount of effort at an international level to try to bring all of these materials together over the last several years. And that has, amongst other things, created the ISSB and pushed a large number of those predecessor voluntary standards making efforts into that single set of international standards. Next slide, please. So I think we can skip over this one because Elizabeth has done this job for me. But as you know, S1 and S2 are out there, and the ISSB implementation around the world is taking shape. There are 30 countries that are looking to implement ISSB at present. Next slide, please. But equally, EFRAG was, as Elizabeth was mentioning, working in parallel. Now, most of you will be familiar with the idea of CSRD, and you'll be aware that in contrast to just focused on questions of financial materiality and the questions that are impacting the company, the European framework is what's termed double materiality and is also looking for impacts on society. So there's a host of information that is being sought within the CSRD framework that is has previously been captured in a number of voluntary standards, including GRI, but is central to what Europe is seeking, in addition to the information that is being captured by the ISSB standards. Now, the ISSB and EFRAG have worked very hard this year to develop a set of alignment materials. There's a lot of good work there, but it only captures those areas where the ISSB standards overlap with EFRAG, which is really just in relation to the overall general requirements and then the climate standards. Next slide, please. The overriding thing to know about CSRD is that this is a pretty changeable topic. So CSRD is the implementation of those EFRAG standards, otherwise known as the ESRS. CSRD is law in Europe, and large listed entities are having to file this, having to prepare their first reports this year, for this fiscal year or calendar year, pardon me, and those materials will need to be filed starting in the new year. For in year one, that's not digital. The expectation is that information will be digital in year two. And as you can see from this slide, there's a rolling set of requirements that go forward, covering smaller entities, including a large number of private companies, some 45,000 of them, it's believed, as well as internationally operating entities that do business in Europe. The fundamental thing to know there is that with a new commission, Europe's not the only, sorry, the US is not the only place that had elections recently. There's still a bit of potential for the timelines to move and the scope to move. We will find out very soon, hopefully before the end of the year. But this is an area where you need expert advice. So I'm not going to try and tell you exactly what you, as company X, will need to be reporting in Europe if you're covered by one of these arrangements. This is something that is changing somewhat at the margins, and you need to be aware of that. Nevertheless, we expect that all of the CSRD implementation, which has been created under the ESRS standards, and there is also an ESRS taxonomy, will be collected in a digital way. Next slide, please. So, and coming to the end here, The point about all of this is that we have a set of, well, closely aligned but not identical standards between Europe and ISSB. Amy's going to talk about what's going on in California, but all of this leads to complexity. And what we like to say at XBRL International is we absolutely love our colleagues within the standard setters, but we don't actually care about them. We only care about the issuers and the users, and this lack of alignment is creating problems for both issuers and users, and we're going to dive into ways that digital connectivity might be able to assist, especially in Stuart's talk in just a few minutes. But next slide, please. Comparability, I mean, it's pretty obvious, right? The vast majority of companies believe that they will be covered, they will be required to report under multiple standards, it's very important that that information is internally consistent. It is very important the definitions are as consistent as possible. It's very important that we can crosswalk this data. So that's our concern in this context. Next slide, please. So what we are expecting to happen is that in addition to that alignment document that I was mentioning, before long, at some point next year, bear in mind that these disclosures are unlikely to be starting in digital form before 2026, and in many countries it'll be 2027, but we will be able to create a digital crosswalk between taxonomies. That process needs to be an official one because, hey, any of us can create some mapping, but really the idea of a concordance is that it be something that is agreed by the standard setters between each other. And they say, right, these things are the same, these things are not the same, and that will give you a way to, both as an issuer or as a user, to be able to utilize the definitions, the digital definitions, in such a fashion as to move from a report that is consistent with one set of standards to another. That's the idea. That's the prototypes. There is work to be done to make sure that this all occurs. But the point is that this really is something that is carried out by or under the supervision of the standard setters themselves, so that you can be confident that you're doing this in a fashion that they've agreed. Next slide, please. So I want to emphasize what Elizabeth said. This is pretty much a seismic change to go from voluntary to mandatory. That process requires new systems, new policies, new procedures, new controls. You're moving from a voluntary disclosure process, which is largely a communications function, into a mandatory one, which is a disclosure function. That's new territory for many sustainability professionals. It's of course old territory for the financial disclosure professionals, but this has to be a merging of this process within corporates right around the world. That is happening in different ways in different parts of the world and amongst different corporates. But that exercise is, I think, the hardest part of this process. Nothing to do with the standard, nothing to do with the digital aspects, but it is just that it needs to be greater levels of rigor in this environment. Next slide, please. So, as I've just said, the trick is to move from a communication function to a disclosure or reporting function, and in many cases that means that these materials will be looked at and reviewed by the C-suite and the audit committee for the first time. In most jurisdictions there's coming assurance obligations in this context, and Amy will talk more about that. But all of that means that you need to treat these sustainability disclosures much more akin to the financial reports that some of you, but not all of you in the room, are very familiar with. Next slide, please. So, and this is where I'm going to wrap up and pass to Amy, but who needs to work on this? This is very much something that pretty much everyone needs to be thinking about. The digital process is going to simplify all of this exercise, we trust. We also think that companies that prepare these materials in a digital fashion from the outset, first of all, it means there's no need for rework, but second of all, it means you're baking in controls that are otherwise very hard to do. So I think we'll have time for some questions at the end, Michelle, but let me pass now to Amy.
Thanks, John. And thanks for everyone for being here today. John talked about generally, the importance of digital reporting in this space and really what's going on around the world. I'm going to kind of bring it home to what's happening. Can you hear me? Sorry. Can you hear me now? Hello? Oh, okay. So what's really happening here in the U.S.? And we talked a little bit about CSRD, and what's very interesting about CSRD is it has extraterritorial impacts on the world. And so John mentioned that those companies doing business in Europe will have to report. Well, there's 10,000 international companies that we estimate will be subject to CSRD. And about 3,000 of those companies are here in the United States. So again, European requirements having an impact on U.S. companies. So I'm going to talk about some of the other requirements here in the U.S. that will also have an impact on U.S. companies. And unfortunately, we don't really know where the SEC rule kind of stands right now. We have guesses based on what happened last week, but I'll just spend a very short time just explaining what it is and where it stands. So the SEC approved its climate rule called the Enhancement and Standardization of Climate-Related Disclosures for Investors. And obviously the rule received a lot of backlash. There were many, many lawsuits filed against the rule, and the SEC immediately put a voluntary stay on the rule pending challenges. The Eighth Circuit Court is supposedly going to hear arguments on the case, and the courts will be able to either suggest modifications to the rule or eliminate it completely. But the requirements are pretty wide and deep. It has implications for the financial statements themselves, where impacts of any weather events would need to be reported in a note disclosure to the financial statements. Those disclosures are subject to ICFR, internal controls over financial reporting, as well as the financial statement auditor and the audit. Again, it also has requirements outside of the financial statements in the 10K, so requirements similar to the TCFD requirements where you'd report climate risks and the impact on the strategy and the outlook, your governance and oversight responsibilities. It also includes requirements for disclosures of greenhouse gas emissions. The SEC rule only requires Scope 1 and Scope 2 disclosures if they are material. It also has an XBRL component, so all of this information is to be reported in inline XBRL and will be phased in. Now, the implementation is supposed to be starting with fiscal years 2025 with reporting in 2026. Given the stay, given where we are, we'll have to see what comes of that. I don't have much more insight than that. But California seems to be a reality. California has two laws that require, again, extraterritorial requirements. So companies that are not only domiciled in the state, but those that are any U.S. company doing business in the state of California will be required to adhere to these laws and report. And so the first is SB 261, which is the Climate-Related Financial Risk Act. And it impacts both public and privately held companies that have over $500 million in revenue doing business in the state. This is similar to the information that is in TCFD, the ISB requirements, as Elizabeth mentioned in the last session. ISB standards can be used to be reported to the state of California. So climate risks, talking about climate risk strategy, oversight, governance, again. The reporting requirements are just to post this information on your website on a biannual basis. This law is effective with fiscal years 2025, and the law actually states that these reports should be posted by January 1 of 2026 and on a biannual basis going forward. Now, 253, which is the Climate Corporate Data Accountability Act, is going to impact companies, both, again, public and private, that do business in the state with revenues over $1 billion in revenue. Now, the reporting requirements for this rule is for scopes 1, 2, and scopes 3 emissions. And so because of that, scope 3 emissions obviously has to do with value chain and what's happening in your value chain. And that's also what the requirements in CSRD. And so we're actually seeing the proliferation throughout the value chains where companies who don't even meet these requirements are also getting requests through their supply chains, through the companies that are subject to these laws, are putting demands on their suppliers to start reporting some of this information. So the impact to reporting is even wider than what I'm talking about, who are companies that are directly impacted by the law. And so, again, these reports, California set up basically not an out, but basically an offering so that if you're a company that's reporting to another jurisdiction, you'll be able to use that report to actually report to the state of California. And I think they had done that anticipating that the SEC rule would be coming through and that you could use your SEC reports and just not cause extra burden on companies, but use that information and report to California. But that's going to be important. Now, the California Air Resources Board is the agency that will be responsible, for coming up with the regulations and the actual requirements for the laws. And the initial law required CARB to set those regulations by January 1st of 2025. And so when Governor Newsom signed these bills, he actually made some comments that there's going to be a need for some cleanup language, and there's going to be some need to give companies some leeway in terms of the implementation. And so there was some negotiation in the state, and a couple months ago, Governor Newsom did sign SB 219, which is an amendment act which amends 253 and 261. Now, basically what that act did is it did extend the implementation, but only for CARB. So the companies are still required right now to be implementing this for fiscal year 2025 in 2026, but CARB has an extension until July of 2025 to finalize their regulations. They're also required CARB is also required to collect this information. So the information actually has to be submitted to CARB. CARB needs to have that information publicly available and in a transparent manner. Now, the laws don't require XBRL today, but it would probably be helpful for CARB if they were to use XBRL to be able to collect the data, make it publicly available. And what 219 did, it allows CARB to actually subcontract with a third party to help them to collect those emissions reports and make them publicly available. SB 19 also allows companies to consolidate their GHG emissions at the parent level rather than individually. And so, moving on, just a little bit about what we expect with the proposed regulations. Obviously, there's obviously been some litigation and some lawsuits that have been filed against California as well as the SEC. Senator Scott Wiener he conducted a webcast yesterday with Watershed, and you can go out and look at that on YouTube. But he was pretty defiant and pretty gung-ho about the laws in California. He thinks that they have a very good chance of fighting any of these lawsuits. He also talked about the fact that, initially there was no budget for CARB to implement these laws, but that has been cleared. CARB's been under a hiring freeze, which is why we haven't seen any progress yet. But he also mentioned that they have authorized CARB to go ahead and hire. So we expect that CARB will be gearing up very shortly for this because they now fully do have the budget and support by the California government. So we expect them to hold workshops, consultations, and then draft proposals to their regulation. They'll be putting out a proposed regulation for comment, and we'll all have a chance to participate with that process. They will probably have a 45-day comment period, and then with an expectation that the regulations will be finalized during 2025. So again, probably a chance to advocate for some improvements to the law and potentially for digital reporting in California, which would allow for companies who are subject to, say, CSRD to be able to use that information and submit directly to California. And actually, Senator Wiener said that on the webcast last night. So I'm going to talk a little bit about the assurance requirements in each of these regulations. And so John kind of mentioned it, and I think Elizabeth did too, the importance of moving from voluntary to mandatory and the importance of the quality of data. And with that, assurance then becomes a really important part of the process. And information that is subject to assurance needs to have documentation. There needs to be an audit trail. There needs to be at a certain level for the auditors to come in and provide that assurance. And so all the assurance requirements usually start with limited assurance and then move up to reasonable assurance. Reasonable assurance is similar to that of a financial statement audit. The auditor is giving an opinion on the information, and that it is in accordance with the criteria, whether it's be the rules or the standards. And so the SEC rule had a requirement starting with limited assurance for the largest companies, 3 years after the initial filing, then moving to eventually reasonable assurance. The assurance requirement for the information outside of the financial statements was on the scopes 1 and 2 emissions. Obviously, the information that was in the financial statements I had mentioned are subject to the financial statement audit. For the CSRD, the entire report is actually subject to limited assurance in the first year. Also, what would be subject to assurance would be the process that the company underwent to determine the materiality of the information being reported. And the EU is going to be monitoring and then determining when they move to reasonable assurance. And finally, California has a requirement in their laws for just the scopes, the GHG emissions to be subject to assurance. And in the first year, it would be scopes 1 and 2 for limited assurance, then moving eventually to, in 2030, for scope 3 to be incorporated, and obviously moving for all of those to be moving to reasonable assurance. So what does that mean? What is the difference between limited and reasonable assurance? And a lot of people ask and want to understand that. Well, I can answer that from a CPA perspective. Other providers also do provide assurance in this space, but they may be using different standards. But in the U.S., CPAs who perform assurance on sustainability information, which is information outside of the financial statements and any information that fall outside of the financial statements, they use the attestation standards that are issued by the AICPA. And so those standards are free and they're open to the public. You can review them and understand what is required. But an assurance engagement really requires an auditor to perform procedures and obtain evidence on the subject matter so that they can make a determination whether it be an opinion or a conclusion, whether it be reasonable, the opinion, or a conclusion, limited, on whether the subject matter is in accordance with the criteria. And so the different levels of assurance, when you're talking about limited assurance, you're just talking about assurance and procedures that are substantially less than reasonable. Mostly the time, the auditor's coming in and performing their procedures that are primarily based on conversations with management, inquiries, where they're getting the evidence to support a conclusion that there's been no modifications that need to be made to that subject matter. When you move to reasonable assurance, again, that's more akin to an audit, where the auditor is going to be doing more detailed testing on the subject matter to the point where they can get enough evidence to be able to provide an opinion. And so, I'm stuck. We're stuck. Well, yeah, okay, last slide. So just talking about what you need to get ready for assurance and why it's so important. Because the auditors will come in and they will need to have documentation and have data trails for the evidence, really companies need to get this robust process in place. And that's the jump that we're talking about between just communication versus disclosure. And so they'll need to establish a program. They'll need to decide who needs to be involved. This is probably a process that goes beyond either the sustainability department or the finance department. There's probably information that needs to get gathered, needs to be gathered from around the company, whether it be HR, legal, operations. So who needs to be involved in that process? You need to identify the requirements. Obviously, there might be multiple requirements that you're going to be reporting under. And so, understand the requirements for your company, understand what's material for your organization, where is that data, identify those sources. They're probably not going to be in areas where it's all in one place, again, throughout the organization or even external to the organization. And finally, establishing those robust processes so that when you come in, and the auditor comes in, this information is documented, and there's an audit trail. And a big part of that is technology. You're going to need tools to be able to accumulate this information, and so there's going to be a lot of need for tool providers to get into this space and help companies with this entire process. So
Great.
thank you.
Thanks, Amy. So I think what we'll do now is we have time for a few questions, and I have a few questions I'd like to ask both Amy and John. And I'm going to stop sharing my screen. So John, I think we'll bring you up here on the screen. Bear with us a second here. And I'm going to start. Let's start with Amy, okay? Since you've been talking a little bit about assurance. How does assurance benefit data users and issuers? We talked a lot about the requirements, but why?
Right. And so it's really important. Investors and users, other stakeholders, want to have reliability and trust in the data. And we're talking about moving the importance of this data to the level of financial statements and the reliability and the confidence that users have with financial statements. Well, part of that process is the assurance. So assurance does provide the consistency, the comparability, and the reliability on the information. You have an external, independent, objective, outside party coming in and performing procedures, obtaining evidence on that information, and so provides you that extra trust. Auditors work in the public interest for that purpose.
Okay, and are investors asking for it?
Yes. We've done a lot of research where investors want assurance on this information because they do want to have the reliance that they are getting with the financial statements.
Okay, that makes sense. John, I have a question for you. You talked about this kind of authoritative, mapping or referencing between the two different taxonomies that are being developed, the EFRAG and the ISSB. Do you have any sense for timing on when that might be available? And also, how would companies use that? What do they actually do with this? Hang on one second. We got to get volume going here. Oh, volume is up.
Sorry, is that working now, Ms.
Yes, it's
Michelle?
working now. Great. Yes.
Okay. So this process is being worked through at a technical level, a proof of concept level. We've got agreement amongst the key stakeholders about how to go forward. That we're not ready to announce timelines yet, but we hope to be able to do so very soon. But let's just describe the way that this will work. We expect that this will work. If you have a concordance between these two taxonomies or any two taxonomies, but these are the ones we're concerned about at this stage, given the way that mandates are coming about, then you will be able to, for example, prepare your CSRD disclosure as a digital inline XBRL document. You'll be able to load that up into your software as well and point it at the concordance or load up the concordance, and it will be able to generate, probably on an 80-20 basis, a draft version of, for example, your ISSB disclosure. It should work both ways, but those of you that have been imbued in this or that were listening earlier, you will realise that the CSRD, the European framework, is currently a much broader set of requirements than the ISSB ones. But that will get you a long way down the path of preparing the report, and it will be entirely consistent with the report you first prepared, and yet be compliant with the requirements of, for example, the ISSB. So it's not magic. It's not going to be perfect. It will only give you a draft, but it's much better than having to prepare from scratch 2 sets of reports. And really, that's what we're driving at with, and as long as the status setters themselves are involved in that exercise, then issuers and users who will also be able to use the concordance for the same purpose to compare an ISSB report and a CSRD report using those mappings, and with confidence that those materials have been reviewed by the standard setters themselves, and the standard setters are happy about those crosswalks. So that's the idea.
Okay, and John, are software companies kind of readying themselves for this? Because I imagine that like a lot of the providers will have to be involved in loading up that concordance and doing that mapping.
So one of the outputs of this exercise is the new XBRL specification. It's a relatively short and simple one. We expect that is something that we'll be deeply involved in over the next several months. But and until that has happened, then the software vendors themselves will only be able to prototype stuff. Look, just to be clear, these disclosure requirements in a digital fashion are the very earliest ones are going to be happening in 2026, and for many countries will be 2027. So there's a little bit of breathing room in terms of having to report in a digital fashion in multiple countries.
Great, thank you. And Amy, I have a question for you. You talked about California 253. It calls for assurance by what they call an independent third-party provider. Can you tell us what that means?
Well, I actually can't. It's actually what CARB really needs to define. However, CPAs do follow independence, ethics, standards, they have oversight, and they have systems of quality management. So we believe that CPAs are well positioned to provide that assurance. Many other mandates around the world do allow for other outside of the CPA profession to provide the assurance, but they are working on standards, the International Assurance Audit and Assurance Standards Board, as well as the International Ethics Standards Board, are updating their codes and standards to allow for others outside of the profession to perform these engagements in accordance with standards, and that's really just to level the playing field. So whatever, we'll be talking to CARB as well during the comment process, but I think whatever requirements that they put in for assurance providers should at least meet those type of benchmarks and those standards that CPAs need to meet.
Okay, great, thank you. I want to thank John and Amy, and we're going to move on to our next session, which is sort of the back end of this, which is talking about how does XBRL, how do data standards actually express climate data, looking at things like greenhouse gas emissions through the Greenhouse Gas Protocol and TCFD. So I'm going to turn it over now to Stuart Rowan, and Stuart is on the line too. So Stuart, if you want to bring up your camera. And Amy, if you want to sit down, you can stay there if you want, but